Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden within the boring business documents. We will be looking at Vanguard's latest shareholder report. And let me tell you, it is packed with more numbers than your grandma's fruitcake has raisins. Alright, so today we are diving deep into the Vanguard Mega Cap Growth Index Fund's annual shareholder report for the period ending the 30th of September 2025. Now this report is essentially a yearly checkup for the fund, telling us how it did, how much it cost investors, and what it owns. Think of it as the fund's report card, but instead of grades, they give you numbers that could mean a lot of money. This report covers the entire year from the 1st of October 2024 to the 30th of September 2025. A lot can happen in a year in the stock market, and this document is a snapshot of all of it for this specific fund. Let us talk about the price tag. Nobody likes paying fees, but in the world of investing, they are a reality. For a hypothetical $10,000 investment in the ETF shares, it cost investors just $8 for the entire year. That is a super low 0.07%. For the institutional shares, it cost even less $7, which is 0.06%. This is dirt cheap and great for investors wanting to keep more of their gains. So how did this fund actually perform? Well, the report says it performed in line with its benchmark for the 12 months ending the 30th of September 2025. That means it basically did as expected relative to the market it is tracking. They talk about market optimism around deregulation, tax cuts, and artificial intelligence, but also concerns about rising interest rates and high stock prices. The Federal Reserve even started cutting interest rates again in September 2025 because the economy was looking a bit uncertain. Technology stocks really drove a lot of the gains, and as of September 2025, technology companies made up over 2/3 of the fund's index, meaning it is heavily weighted in tech. This concentration means if tech does well, the fund tends to do very well. But if tech stumbles, the fund could be more volatile. Now let us look at the long term. This table shows what $10,000 invested at the start of this period would have grown to. It is pretty impressive to see the numbers climb year after year. You can see the initial $10,000 in 2015 grew to a whopping $56,289 by the 30th of September 25 for the ETF shares. That is a fantastic return over a decade. Looking at the average annual returns, we see more of this strong performance. For the ETF shares, the average annual return over 10 years was 18.86%. That is incredibly strong growth year after year. Even over 5 years, it was 17.35%. And for the latest year, it was 25.58%. The benchmark index, it tracks the CRSP US Mega Cap Growth Index, performed very similarly, showing that the fund is doing a good job of mirroring its performance. The Dow Jones US Total Stock Market Float Adjusted Index, a broader market index, had lower returns at 14.64% over 10 years, which highlights the growth focus of this particular Vanguard fund. Let us check out some key statistics as of the 30th of September 2025. The fund manages a massive $31.3 billion. It holds 69 different companies. The portfolio turnover rate is 14%, meaning they are not frantically buying and selling stocks all the time, which generally is good for keeping costs down. The total investment advisory fees for the entire fund were just about $551,000, which is incredibly low given the amount of money they are managing. Now let us see where all that money is invested. As you can see, technology dominates with 68.3% of the net assets invested in tech companies. Consumer discretionary comes in second at 16.1%. Healthcare is at 4.7%, and industrials are at 6.1%. This heavy concentration in technology is what makes it a growth fund, and it is the driving force behind those impressive 10-year returns. This next part is for the institutional shares class of the fund. For the most part, the performance and holdings are very similar to the ETF shares as they track the same index. The cost is even slightly lower for institutional investors, which makes sense. Just like with the ETF shares, the institutional shares have also seen fantastic growth over the past 10 years. For example, an initial investment of $5 million grew to over $28 million by the 30th of September 2025. That is more than a 5-fold increase in 10 years. That is the kind of wealth building that investors look for. The average annual returns for institutional shares are almost identical to the ETF shares and its benchmark, showing consistent and strong performance. Moving on, the report mentions that the fund has adopted a code of ethics for its top executives. This is standard practice, ensuring that the people running the show are acting in the best interest of the fund and its investors. They even made some minor updates to it this year. The report also tells us that the audit committee, which oversees the financial reporting and is a crucial part of good governance, has members who are both financial experts and independent. This is important for investor confidence and ensuring that financial reporting is fair and accurate. This section is all about the auditor PricewaterhouseCoopers or PwC. They are like the independent inspectors of the fund's financial health. For the fiscal year ending the 30th of September 2025, the audit fees were $690,000 and for the prior year $794,000. There were no fees for audit-related tax or other services, which means PwC was only focused on auditing the fund's financials. This is a good sign of independence. The report also details how the audit committee pre-approves all services provided by PwC, ensuring transparency. Looking at the total fees paid to the auditor for the registrant, only it was $690,000 for 2025 and $794,000 for 2024. However, when you look at the non-audit fees paid to other Vanguard entities, it totals over $5 million for each year. This includes audit-related fees like $3.8 million and tax fees like $1.7 million in 2025. This is normal as these services are for the entire Vanguard complex, not just this specific fund. The fund is a listed issuer, meaning it is subject to specific rules under the Securities Exchange Act. It has a dedicated audit committee with the same members we mentioned earlier: Sarah Bloom, Ruskin, Peter F. Folanaki's Tara Bunch, and Mark Luffridge, all working to ensure proper financial oversight. Now we get to the nitty-gritty, the financial statements themselves. This is where all the detailed numbers live. This is the heart of what the fund owns. Looking at the schedule of investments as of the 30th of September 2025, we see the actual companies the fund has invested in. For example, Nvidia Corporation is listed with a market value of over $4.3 billion. Microsoft Corporation and Apple Inc. are also among the top holdings, each valued in the billions. This confirms that massive chunk of the fund is in these mega-cap tech giants. The total value of common stocks held is over $31.2 billion based on a cost of over $20.2 billion. This shows a significant gain on their investments. There is also a small holding in the Vanguard Market Liquidity Fund worth about $70 million. This is likely for managing daily cash needs. The fund also uses derivatives like futures contracts and over-the-counter total return swaps. For example, they have E-mini Nasdaq 100 index futures contracts with a notional amount of almost $1.5 billion. They also have a Visa Inc. class, a total return swap. These are tools to manage exposure, but also introduce risks like counterparty risk if the other party in the swap defaults. This statement gives us a snapshot of the fund's financial position at a specific point in time. As of the 30th of September 2025, total assets are over $31.3 billion, while total liabilities are a mere $27 million. This results in net assets of over $31.3 billion. The difference between paid in capital and total distributable earnings gives us a picture of how the fund's value has grown over time. The net asset value per S-share for ETF shares is $402.45. This is the price per S-share based on the value of all the assets the fund holds. And for institutional shares, it is $799.42 per S-share. This statement shows the fund's income and expenses over the year. Total income from dividends and interest was $126.6 million. Total expenses were about $18 million. This means the net investment income for the year was over $108 million. That is some serious money being generated. The fund also had significant realized gains from selling investments, totaling nearly $2 billion. And the change in unrealized appreciation on investments was over $4 billion. This means the value of investments that the fund still holds went up by a lot of money. Putting it all together, the net increase in net assets from operations for the year was over $6.1 billion. This is a testament to the fund's strong performance. This statement walks us through the changes in the fund's net assets over the year. The net increase from operations was over $6.1 billion. Distributions to shareholders were significant at over $115 million. Capital share transactions, meaning new money coming in and money being withdrawn, led to another increase of over $2.2 billion. All this combined led to a total increase in net assets of over $8.2 billion for the year. These tables provide a lot of key performance indicators per S-share. For ETF shares, we can see the net asset value per S-share grew from $321.87 to $402.45 over the year. The total return for the year was a fantastic 25.58%. The ratio of total expenses to average net assets is impressively low at just 0.07%. That is why many investors choose index funds. They offer great performance with minimal cost. The same trend holds for institutional shares with the net asset value per S-Hair growing from $639.36 to $799.42, and a total return of 25.59%. Again, the expense ratio is even lower at 0.06%. The notes provide crucial details about the fund's accounting policies and how it operates. They explain how securities are valued, how derivatives like futures and swaps are used, and the risks involved. For example, they detail the management fee structure and how expenses are allocated between the different share classes. They also discuss the potential impact of market disruptions and concentration in specific sectors. This is the auditor's stamp of approval. PricewaterhouseCoopers LLP confirmed that the financial statements are presented fairly in all material respects in accordance with generally accepted accounting principles. This provides an important layer of credibility to the financial data. The tax information section provides details for shareholders on how their distributions might be treated for tax purposes. It mentions qualified dividend income and interest earned from US government obligations which can have tax advantages. Finally, the report lists the exhibits that are filed along with it. This includes the Code of Ethics and Certifications. Now, for my take on this filing, Vanguard's Megacap Growth Index Fund, as shown in this report, continues to be a powerhouse. The consistent outperformance over the last decade, driven by a heavy concentration in technology, is remarkable. The extremely low expense ratios for both ETF and institutional shares mean investors keep more of their hard-earned money. The fund's strategy of tracking a major growth index has clearly paid off handsomely for its shareholders. The main strength here is the historical performance and the low-cost structure. The weakness, or rather the risk, is that heavy concentration in technology. While it has been a massive win, it also means the fund's performance is heavily tied to the fortunes of a few giant tech companies. If the tech sector faces a significant downturn, it could impact this fund more than a more diversified fund. However, the fund's objective is specifically to track this megacap growth index, which is by nature concentrated. It is doing exactly what it is designed to do and doing it exceptionally well. So in conclusion, this report paints a picture of a very successful fund that has delivered strong returns over the long term thanks to its focus on growth-oriented megacap companies and its incredibly low cost. It is a great example of how a well-managed index fund can be a powerful wealth-building tool. Alright, that is our deep dive into the Vanguard Megacap Growth Index Fund's annual report. What do you think about its tech-heavy strategy and its impressive performance? Let me know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button and subscribe for more corporate insights. And don't forget to join our Discord community linked in the description. Thanks for watching, and see you next time.